Good morning, ladies and gentlemen, and welcome to the Finance Magnates Summit. My name is Dushka, and in these 2 days, I will guide you through the Innovate stage. To kick off the first day, I'm happy to announce the first session, Risk Management for Brokers, to be or not to be. I will hand over the stage to our moderator. Please welcome Anya Aratovskaya from Advanced Markets.
Hi, everyone. Welcome to the panel, to be or not to be. The answer to this question might seem straightforward, but there is a lot to unpack and explore. We are fortunate today to have 5 very experienced panelists with years in FX. And let's start with a brief introduction. Introduce yourself, your company, and how you're connected or exposed to the institutional or retail risk management.
Okay, good morning, everyone. I'm Maria Pittashi from PLUGIT. I'm the general manager. PLUGIT has been around since 2012. We do Forex brokerage solutions on MT4, MT5 platform, ranging anywhere from MAM-PAM, dynamic margin, our IB affiliate management solution, bonus automation, CRM. So yeah, we're happy with working with any range or size of customers. We tend to be able to partner with our clients to be able to make sure that our products are a good fit and helping with their workflows and streamline their efficiency.
Hi, I'm Gregoriou. I'm the CEO of TraderTools. TraderTools is essentially the new product we introduced in the last few years, which is probably what we're selling, is basically electronic market maker in a box. And so it allows, brokers, primarily TraderTools you sell to regional banks, but we sell it to brokers as well, is the ability to essentially run an algorithmic trading operation that's true market making, which, again, in your be to not to be thing for a piece of the business, we think makes lots of sense.
Good morning, everyone. My name is Nick Serff. I am head of trading at Exinity. Previously to that, I was head of trading at Anya, and before that, I was senior market maker at City Index. I'd like to say that I've probably had a career in retail across the years. Currently at Exinity, we're in the process of launching our new Exinity Connect brand, which is what we've been preparing for the whole of 2023. We offer, obviously, a range of CFDs, FX, cryptos, and single stocks.
Hello, welcome. My name is Angelos Gregoriou. I'm the CEO of Dynamic Works. It was incepted back 20 years ago. And the last 6 to 7 years, we're focusing on the financial market. We are very experienced in the CRM, so we carry all this experience from the previous 15 years in CRMs to the financial market. And we also offer in our solutions all the client touch points, such as client portals, mobile applications, IB portals, affiliate portals, and actually everything except trading platforms with which we are integrated.
Awesome, thank you. Thank you for the introduction. Let's dive in. 2023 has been an interesting year for retail and institutional brokers in terms of trading volumes and profitability. I believe that market conditions and 2023 as a whole made retail brokers way more inventive on the risk management side. And speaking about that, I want to ask panelists on what do you think are the risk management strategies that retail brokers should implement or perhaps avoid moving forward? Drew, would you like to start?
Sure. So I think obviously everybody knows that, people today most brokers have an A book and have a B book, and they sort of very absolutely either one or the other, or look for either for a piece of their business. And I think that one of the things that people are finding out that, obviously everybody knows the full sort of shortcomings of both, and what we pitch sort of as a hybrid model to do sort of in the middle. And, there is not really one answer for every broker, and every broker sort of has to customize for every kind of client, for every currency instrument, right, kind of their own, thing. And I think that where people have to really sort of fix what we were doing today, obviously there's an end-to-end. There's a pricing problem in the market, like gold is a very common thing, which is half the volume at most brokers, is underpriced to the client, and therefore, in current format, actually cannot be A-booked because people are selling it too cheaply to clients.
So you would say brokers should focus on optimizing their pricing first, and then kind of moving from
So yeah,
there.
so if you think about sort of, there's like 3 different problems. There's an analysis problem of what clients should be in each book, right? There is a pricing issue where we're pricing in a world where we used to B-book everything. It didn't matter what the price was because we were bucketing it all anyway. In a world where we have to A-book some of it, if it's too narrow, it can't be, right? Or you lose money on it. And so like there has to be, you know, a much more sophisticated approach to take. For example, the super narrow price is good for small clients. This is not good for large clients, right? So how people do their pricing, and then obviously the third component, how do you hedge it? And this is where sort of the issues are even more so.
Thank you. Thank you. That's very insightful. Anybody wants to add anything? We'll move on.
I can add?
Yeah.
So I definitely agree with you. I think it is something where there isn't this set formula for each broker, and we have to understand that it is different for each broker, and setting that risk management techniques that they're going to use, the strategy that they're going to set on isn't necessarily specific. Each one of them obviously has to go for strategies that fit what it is with their pricing strategy, with everything that they're doing with regards to their own risk appetite. So yeah, I definitely don't think it is one set clear answer. As a summary, yes, definitely, as he was mentioning as well, liquidity pools, being able to, you know, limit your exposure that you would have to price volatility. But other than that as well, looking into certain aspects of the business of being able to say what it is that you need. Other than that, data, your analytics, and of course, looking into specific areas like your leveraging, like your tiering margin.
And actually, on that point, what would be the elements of exemplary risk management framework? For instance, clear P&L benchmarks set by shareholders, passive risk management in the form of real-time order book monitoring. I know some brokers are not doing that now. Then there is also active risk management, which is A, B, C book hedging. So how would you define the must-have elements from the, let's say, technology side?
Yeah, definitely. And as you were saying, I don't think A booking, B booking, it's not, as Drew had mentioned, a clear line of what it is that you're doing. I think the hybrid solutions of C booking is something also that a lot of brokers are definitely looking into as a must to be able to keep up with the times. And as we say, risk management itself is also evolving. It isn't this thing that is clearly defined or set. If we're looking at a generalization across the board for brokers, as I mentioned, the deep liquidity pools, being able to limit your exposure to price volatility, being able to say that you're looking at your leverage to be able to change margin and keeping up to date with that and limiting the exposure from that side as well. And then just looking again, as we said, data analytics, being able to keep ahead of what it is so you've got the bigger picture to be able to make those decisions.
Thank you so much. Okay, continuing the discussion about the frameworks and risk management strategies. Nick, you are head of trading at the large retail brokerage, would you mind sharing, what is the Exinity's risk approach in 2023, maybe 2024?
Yeah, of course. So I think, and the team are obviously there, so they'll correct me if I'm wrong, but I think we do one trade every 10 milliseconds. So obviously our internalization rates are quite high, especially on the more popular, heavily traded instruments. But I think to the question is that where we started 2023 wasn't so much where we did want to take risk, but where we didn't want to take risk. And we looked at the instruments where we would see a lot of concentration and not so heavy internalization rates. And those were the instruments, straight away that we looked at them and we said, okay, well, we probably don't want to be internalizing these because we don't see the internalization rates. So that is what, one of the first steps we took, where we looked to externalize the smaller, more concentrated instruments. The second part was more, let's do a sort of overall health check of the book. So, do we have toxicity in the book that could potentially be risk reducing, that has sharp markout that we want to keep within the book? or do we want to actually, externalize a portion of that as well? So, we done a health check on the book as well to make sure that we were happy with the toxicity that was in there as well. And then once we'd done that, we then obviously looked at what we wanted to do on our risk-reducing cycles. So the idea here is that on our higher internalisation instruments, we would try and internalise as much of that risk as possible over a set period, and then we would hit one of our risk cycles where we would reduce any excess built-up risk on top of that. And then obviously our smaller instruments that I just spoke about, they would be on a shorter, risk-reducing cycle. And it's very much in the belief that, we look at what clients pay effectively as being the markup on the swaps that we charge, the spread, and the commissions. The client loss part of the sort of traditional B book per se, we're not really looking to capture that. So that was, in a nutshell, 2023.
Okay, interesting. And then what would you say the main challenges for you? Is it finding, let's say, an LP that is able to give you like a higher NLP, or is it more about technology? So what are the challenges that you face?
We've been quite lucky that we've got good relationships with, with our LPs, prime brokers, etc. So we're not so much concerned on that side. Obviously, we're externalising risk. So we look at, what is our credit relationship with those counterparties. We go through all the normal checks that they would do on us, etc. The technology side is interesting. We've gone through quite a big change this year on the technology side. You mentioned it earlier, and I know Drew mentioned it earlier, is that you need all of these data points now, all of the TCA analysis. You need all of that to make these informed decisions when you're looking at carry trading, toxicity, everything that makes up the internalisation of your book. You need all of these metrics. So yeah, that was a big part of it this year for us.
Okay. Thank you for your answer. Moving on, let's start a discussion or maybe cover the aspect of like brokers have a lot of risks on their books. I mean, it's counterparty risks. I mean, risks related to technology and so on. Angelos, you've been working with dozens of retail brokers, and you're known, for as a company that does CRM solutions, and then you have quite a few other products as well. Can you talk a little bit more about what risks are you helping to solve, and then?
Yes, thanks for the question. And there are many other risks, obviously, in a company, in a brokerage, other than the dealing-related risks. And we've seen a lot. We experienced risks that are coming from the inside of the company, from the staff, trying to probably cheat in a way with manipulating internal information. So that's one risk. We've seen other risks of team members probably leaking data. That's another risk. It's a huge risk for many businesses. And we've seen also risks that are coming from customers who are not really legit. You can observe using patterns. Who is this customer? Has his IP been used in fraud anywhere else? So there are big databases that contain this information, and if needed, we integrate it with that, and we give this information to brokers. So the other things, what are the patterns of the clients who are logging in? Are they clients that are using potentially 2 or 3 different profiles logging in from the same IP addresses, passwords, or emails? So there are patterns that these are the simple ones, and then it's the other more complicated ones where you need to investigate all the logs that you have on the servers, on the CRM, on the client portal, and come up with conclusions of for the behavior of your customers. So these are some of the risks that we are dealing with.
So brokers would have, even before they decide whether they B-book or A-book or do any other strategies, they would have to evaluate this information first.
I believe that they have to do both at the same time, and it's different departments, of course, but these are very important information. We've seen a lot with, especially with big retail brokers, where there's a lot of data, a lot of customers, and you cannot, the staff is not able to monitor each and every one of them. So you need to have alerting there to inform about these kind of risks.
Great, thank you. Let's talk a little bit more about the technology, since three panelists here are working for technology firms. What would you say are your top 2 selling risk management tools in 2023? And is it different compared to, let's say, 2022?
So it is different in the sense that we did definitely add a lot of additions to our products for 23 to kind of keep up with certain requests from customers. So we did see that there was a change in what customers were requiring from their certain risk management solutions. For us, our dynamic margin is probably by far the number 1 selling module that we have in general, not just for risk management. And the aspect of that is basically being able to say that, again, your margin tiering, your leverage, and being able to take into consideration the entire exposure that your trading or your company or brokerage has, to be able to then accordingly set your leverage and your margin levels that would be impacting your customers in your exposure.
So dynamic leverage.
Yeah, dynamic margin is what we're calling our product, our solution, but yes, dynamic leverage. And that's what it is. So it's not just a matter of us being able to say that, yes, you're able to dynamically, change the leverage as you need to be able to, set your exposure limits basically to protect your brokerage. But when I was referring to updates that brokers that we've seen, they're requesting, session periods is something that we've definitely seen that is coming more as a request that we've added into our solution. So being able to set certain sessions for high volatility trading time, to be able to say, okay, during these high volatile times, during big economic calendar events, to be able to adjust the leverage according to those times, and then dynamically be able to revert back to its original leverage positions or leverage levels that we had before or after the time session expires. So that was one aspect that we definitely saw a lot of requests coming in on, and then smaller different changes with regards to setting the exposure. So it's on the net open positions, but not only that, but also looking deeper and being able to say that you're able to say not just on lot sizes or notional value, but also on equity of the account. So these were updates that we made to our solution, which came in time, I think, with many requests and aligned with what was needed in the market.
Okay, thank you. Drew?
So I think kind of our, top few things. I mean, one is, our sort of biggest selling point traditionally has been sort of just the hedging algorithm, right? So you take the stuff that people would usually A-book, and you say, okay, because it's retail business, it usually has a good markout for like 5 minutes, and you say, I'm going to take 5 minutes of risk instead of A-book it instantaneously, and say, okay, how much can I, in that 5 minutes, hedge passively, which earn the spread instead of pay the spread, because I'm going to, and we have the distribution to ECNs and places where you can go and try to be a market maker to earn the spread on the other side of what the retail client gave you. And as time goes on, right, you have the algo that says, okay, I'm looking for a choice price of all my LPs. And if I can't find one, and I can't find a passive way to earn a spread, and I can't pay zero, then I go hit the best bid offer, right? So it's kind of like in that 5 minutes, how much more can I earn on my A-book other than just the markup and the swap and all the stuff that I would do? And once you set a benchmark for how much you actually earn on the A-book now, which is going to be significantly higher, especially like Nick was saying on the minor currencies tend to be higher spread, those tend to be higher. But you then going to set a benchmark of how much of the B-book is unnecessarily to be B-booked, because now that there's a higher yield on the A-book, how much do I not have to take a risk because I have similar yield here? And there's still always going to be most of the business, especially for bigger brokers, is still going to be a B-book. The math is always going to be better for the B-book, but people are doing a 95-5 instead of really 75-25 if they earned enough on the A-book to actually.
That's a good point. Right? I mean, Advanced Market is a liquidity provider, and sometimes I have to argue with the dealers that having a 95-5 risk management strategy is not always a good approach. Now, I can justify me arguing with them by sending them a video of this and then Drew talking about it. Okay.
But I think the other two things really, there's the pricing element, like I was talking about earlier, is that brokers are not attaching a particular liquidity to a price. So like in gold, like very typically, they say, oh, 10 cents. And yes, it's fine when somebody hits you for 10 ounces for 10 cents, but not fine when someone says 1,000 ounces, 1,000 ounces, 1,000 ounces, 1,000 ounces. And you just got hit for 10,000 ounces, you know, at 10 cents. And if you went to the CME, which is the benchmark for gold, to try to hedge that, that would cost you $1.50, you know. And I think that people sort of like we found at 5 different brokers at inception, which is at point 0 of when your customer hits you, large customers in gold, people have lost $500,000 because it's not an unrealized realized P&L. People don't see it. Well, that's how. So some of it turns around, and people lose, but some of it doesn't. And when you start out as a market maker, you should not be giving out positive spreads. Right? And that's what people are doing, right? So some of it is controlling the price and liquidity. Some of it is saying, this client, I set a risk tolerance, rate tolerance of even if it's like a little bit off, I still want it because it's small and it's friendly and it's usually be bookable. But these clients are sharp, and unless they hit me at my price, and unless they, you know, and I want a last look that's a little longer than the 5 milliseconds that I would do for a friendly client, maybe I want 100. Which is still a third of a blink of an eye, so most clients won't see it, but you need something to say, am I being picked off or not? So like there's the pricing, there's multiple levers to the price itself, and that doesn't even touching hedging, right? And then the third thing, which is obviously the beginning of all, and I think that the data analysis, what people are, most people are looking at absolute P&L from a data analysis and saying, well, these 10 guys, the 8 holes that just hosed me last month, so they're moving to the 8 book, right? But generally speaking, those clients got lucky. They're not good traders. And so then the next month they lose money. You're like, oh, who moved these idiots to the 8 book? You know, and then the reality is that you have to do the analysis of who's actually a good trader and who isn't, not who just made money. And then also from a regime perspective, we're in range-bound markets. There's clients that everybody knows and experience this negatively, that made lots of money in range-bound markets, will not when the market turns around. Everybody knows that, we just don't know when the market will turn. And so like that, sort of fitting the thing to the regime a little bit is important, right? And fitting, clients do a lot more of smarter data analysis of, sort of like, here's the EA that's toxic. Nobody advertises they're using the EA when they sign up, so can you do a pattern that detects this is the EA? You know what I mean? So like those kind of the 3, I think, main things that we bring to the table.
And then from your perspective as a technology provider, what tools, like people asking, so you are offering system as a whole, or is there any particular tool that you'll say, okay, this is a price engine tool that I'm offering, that's what is like popular now?
So you can use this. We've never done data analysis alone, but we generally do data analysis part of everything, but like generally some people use it just for the price, right? Just for the pricing engine portion of it, and they don't use this for hedging algos, and some people use this for the price and the hedging algos.
You also do hedging algos?
Yeah.
Okay.
And the hedging algos is kind of our traditional thing. I would say it's sort of the sexy thing that we sell is the hedging stuff, especially the passive hedging, because that's mostly brokers don't. Usually brokers, when they A-book, they just hit an LP, pay the spread, and buy, right? They don't try to earn the spread, and I think it's a shame. But the thing that I generally think would find most useful in the beginning and the easiest to implement is the pricing stuff.
Thank you. Thank you. My next question, well, I have to ask it because it's trending. It's two magic words, artificial intelligence. Angelos, Maria, how do you foresee the development of certain tools, for your companies, and maybe overall consider all hype that's going on, consider all the development of machine learning and AI? I'm going to say that word again.
Obviously, from a security risk assessment and prevention. It's the AI analysis of all those millions of informations of logs, where are they scattered in different servers, in the systems, in the trading systems, on the CRM database that you can analyze. Usually, what brokers do, that they come to analyze the logs after an incident happens. Okay, how did this happen? Yeah. So the most important thing that we're doing going forward with AI is to analyze those logs and prevent any security-related or fraud-related actions that will happen going forward. And that's the main focus of our company going forward with the IA right now.
Awesome.
I think, gosh, AI is such a broad topic as well at this point, and seeing where companies are going and seeing that we all see and say that, okay, we're going to look at what technology we can do and what we can provide as a service provider, looking at the risk management tools that we can put in. But the tool is only as good as the data that obviously is coming into it. And as I think it was Nick that was mentioning before as well, being able to say that you're getting all the accurate data and all the information from your liquidity provider coming into that system, being able to actually analyze that data and actually then put it to the good use of data analytics, and being able to kind of get a bigger picture of what kind of decisions you can make from it. Now, with regards to AI, what PLUGIT would be looking at, or what we're looking at in the future, is not, for us, dynamic margin, as I mentioned, is the tool that we find is most useful for our customers in this area with regards to risk management. I wouldn't necessarily say it's something where AI comes into it, other than pulling, like we said, like looking at the data, being able to say that we're giving a better, broader picture for brokers to be able to control that risk, to be able to say that they've got a good idea and an understanding of what it is that's coming into the system for them to make better decisions. But I guess with AI, like I think
it's still too early for retail brokers to implement any aspects of.
No, definitely nothing I think is ever too early. I think with this kind of game with technology as well, it's just the sooner you're in that area, you always seem to be behind anyway with regards to technology. The next thing and the next thing is always coming. And again, it depends on the feedback that we're getting from the industry, from the markets, their requirements, and being able to stay that one step ahead of their requirements and what they need. And I think as well with this morning's news on OpenAI, threat with all their employees out. I think there's a lot of smart people up for grabs.
Yeah, lots of drama going on for sure. So, a question to everybody, I guess. So, would you say the risk management of 2024 is all about data, or it's all about people, or it's all about counterparty? What is the risk management in 2004 is about?
I think it's everything, has a role. But I think just for the AI stuff, I think that people just have to look at it from what is feasible and what is not. AI will never be able to predict market conditions. Will never be able to predict where the market's going, and it's all the people who are trying. That's the customers, right? And there's a reason why the people who exist, because even with AI, they won't make it right. But you
predict the customer behavior now.
No, so the thing that machine learning can do well, right, is go and say, okay, if the customers are positioned this way before an event, we can't predict the outcome of an event, but if the outcome's positive and everyone's long, market's not going to move that much because everyone's already long, right? And that's what machine learning will tell you. If the outcome's negative and everyone's long, everyone's going to get hosed, right? So you have to make sure, like what Nick was saying, is my data the accurate data? Do I have captured the crowd, or do I need to know what 5 other people know to make sure that I have the thing? Or is my data just 5 large clients who are long, and therefore maybe I'm at risk? So I think a lot of this is sort of understanding, the limitations of what data can do, right? Because the limitations to everything, there's people, data, all the systems, they all sort of have to work together, but there's stuff that data can be very concrete about, and there's stuff that it won't. There's no magic that it can do.
Okay. Anybody else want to add anything? We're good. Okay. I think I'm out of my questions. I mean, I have more questions, but I'm afraid if I'm going to start them, it's going to take longer. Is there anything you want to add or to say to our attendees in general related to risk management or things that retail brokers should be looking at?
I would probably add that we've definitely seen in 2023 has been the year of the carry trader. I think the carry trade is now definitely back with interest rates being where they are. If you are running an internalization model and you do have large elements of, gold, build-up, Swiss, yen, etc., then that is definitely one element of concentration risk that you should be looking at. So, it's been a big focus for us this year, and obviously leading on from that, the second part of it is the swap-free element. There are a lot of brokers out there still offering a lot of swap-free products. And I think the price of swap-free now has fundamentally changed from what it was 6 months to 12 months ago. So those are two sort of key areas where I think retail brokers that run internalization books should be looking at.
Thank you so much. Thank you for participating in the panel. I think we have a few more minutes left, so we can take a couple of questions from the audience. Anyone would like to ask a question? Razvan? Okay. All right. So thank you so much for attending, and thank you for participating in discussion.
Thank you too, Anya.
Thank you.
Thank you.
That's it.